At the risk of treading a well-worn path, it's been a pretty awful year for equity investors by and large. We keep hearing about the narrowness of the upside that we've seen with some really big companies driving some really big returns. But by and large, some of the relatively smaller companies have been finding the going tough. And I'm talking here mainly about small cap companies. And because we're talking about British stocks today, we're talking mainly about the AIM index. I'm pleased to be joined now by a regular guest here at IGTV. It's Chris Boxall from Fundamental Asset Management, where you run portfolios, don't you, for
Absolutely,
people in the AIM market with a specialism twisted towards long-term investments. And oh boy, what a year.
It's been tough. It's been very, very tough. And it's been a sort of slightly different experience than previous. I mean, we had some tough times before. Financial crisis, Brexit woes. You know, we've been doing this for 20 odd years in AIM. And this one's a bit different. It's just this grind down all the time. Previously, financial crisis, we had a huge sell-off, then a very, a massive bounce, up, the AIM index up 60% the year following and continued to keep going higher. But we've had this sort of grind down, and people have been asking us, look, what's the key difference now? How is it different now? And really, it's interest rates. I mean, interest rates and inflation, but primarily interest rates. That's the prime concern.
You're an accountant. You drill down on a lot of these numbers. How different is it in terms of debt as well? Because that's something else we're hearing a lot about companies, the amount of debt they took on when interest rates were relatively low. And now interest rates have doubled, tripled in some cases. And the debt that's on the balance sheet is now costing an awful lot more. Does that affect AIM the same way?
It does, but the quality of AIM has improved a lot. I mean, the number of companies that have shrunk a lot. I mean, it used to be double the size in terms of number of companies, but the quality of companies has improved. And when we talk about quality, they're better established generally. There are a few sort of speculative companies. And dealing with the debt question, their balance sheets are generally far stronger. Those companies that are running higher levels of debt, and we're talking about one later on, but typically they've got very, very strong cash flows and very repeatable, reliable cash flows. That's slightly different. So we haven't got the debt worry. And a lot of our stocks in our book, I mean, the vast majority, 85% of them are in a net cash position. So a lot of those businesses are going to be benefiting from higher interest rates. It's noticeable that below the line interest income, finance income is going up a lot. Because they're benefiting from whatever they can get in the bank now. So that has changed. That's reassuring and far better than it used to be.
To be fair, that is the same across the board, isn't it, for large caps as well?
Absolutely.
So to a point, it's the same path, as I've said. We're walking down for the big caps as well, isn't it?
I would say it's slightly different. A mature large cap business, and we're generalising here, but a mature larger cap business that's been around a long time has typically squeezed markets and pushing its balance sheet. So you'll see a lot of them carrying a lot of debt. I mean, I'm talking about historic legacy businesses. They're not only that, they're carrying often a lot of lease liabilities. A lot of the more elderly main market stocks it's all got big pension deficits. So their cash flow, the demands on their cash is slightly different to a younger, more nascent, earlier stage business. Earlier stage, a lot of these AIM companies have been around for decades, but they haven't got the sort of the millstone of pension deficits. A lot of them have got relatively modest lease liabilities as well. And as I say, they're in a net cash position. So there is a slightly different dynamic to a lot of main market companies.
And of course, the other thing I should also mention, and we were to discuss really, is liquidity, because I imagine small cap companies don't have that large, typical sort of blue chip liquidity you get on a daily basis.
No, I mean, that's been a big problem. You've got some limited liquidity, smaller quoted companies. Nobody wants to buy their shares. So they're getting a heap of money in the bank at whatever it is, 5%. And at the same time, you're getting institutional sellers. Funds are having redemptions. So the liquidity has just dried up amongst smaller quoted companies. The volume of shares being traded is massively down. You can see that in the monthly stats that the LSE produce. You're seeing that those traded volumes are much lower than they were a year ago, which is impacting things.
Well, I was going to say, to what degree does that impact on, let's say a company reports a disappointing number for their quarterly or half-yearly figures or whatever. Does liquidity impact the share price move, and to what sort of degree?
Yeah, you're seeing a relatively small number of traded shares, sellers, have a huge impact on the share price. I mean, if companies are missing nowadays, or they're missing earnings, or if there's any slight sort of doubt or whiff of or concern in the outlook statement, suddenly you're seeing 20% wiped off their shares, which is, quite frankly ludicrous on occasions. But it's the fact there are, not many buyers, market makers are, the spread's widening, and you got few sellers coming in because people think it's irrational, but are not inclined to come in and buy and support the price. So that is exacerbating returns. More positively, for those that are patient, this creates a great opportunity. You're seeing it's absolutely bonkers in places, some of the sell-offs.
Well, let's ask a question in that case about the business rather than the stock price, because the stock price doesn't necessarily follow. And of course, the chief executives and the board don't have a control over where the stock price goes. What they can do is they can ensure that they've got a good, solid business model, which of course then goes on the tick box side for investment potential. How are some of these businesses going? I mean, under the covers, are you seeing disjoint between the share price and the business performance?
We're seeing a few warnings, but they don't seem too bad. Generally speaking, companies, their real returns are holding up pretty well. You're still seeing growth. The acquisition activities die down a bit, so they're having to focus on organic growth, which I think is a good thing. You had this period of acquisition mania fueled by, in many companies, not all, fueled by a generous stock market. Well, that's stopped. The tide's gone out now, and we need to see companies actually deliver rather than just keep buying here, there, and everywhere. But their balance sheets are a good shape, as I say, and trading isn't bad, but that's not being reflected in the share price. You're seeing some really decent businesses with decent long-term prospects trading at dirt cheap valuations. The key question is when are things going to turn, and how patient are investors going to be? And unfortunately, we haven't seen a lot of patience by our larger institutional investors, and they really need to be looking at themselves and think, come on, join the party here. Show a bit of ambition and patience.
Well, this is one of the things, isn't it, that's interesting politically, because isn't there some rumour that Jeremy Hunt is likely to find ways to ensure that people invest some of their pension funds into UK companies? Is this what he's trying to do?
Well, there is a suggestion that, the UK pension funds are going to be obliged to invest in unlisted securities, a good chunk of a certain percentage of their assets, and that includes AIM. That sounds a positive move to us, but aside from the pension funds, the other institutional investors, I just do not understand the landscape at the moment, because you've got some good companies, many good companies are being bought out seemingly on the cheap by private equity and also other industry players. Now, why on earth I and my peers invest in the small cap and AIM market for hopefully multi-bagger returns? Otherwise, quite frankly, we might as well just stick to US blue chips. I mean, it's far easier. If you're only in it for gradual compounding, stick to that. If you want more excitement, you want to hopefully get a better return, small caps are going to be your place. So why on earth, at the moment, are UK institutions flogging out for 20-30% premium? Oh, whoopee-doo, we get a quick premium. Where else are they going to put their money? The stock market's shrinking. They're selling out of good quality companies with great long-term growth prospects. Maybe tricky at the moment, but conceivably in 3 years, 4 years' time, with a little bit of patience, they may be twice, 3 times the size. So why accept a cheapskate 20%, 30% now, when you can, with a little bit of patience and a smidgen of ambition, support it to greater things.
Okay, before we get on to some of the picks you're going to give us today, I think you've got 4 in total. Just one final question. What should it be that we as investors should be focusing in on to try and fish out those or haul in those companies that have hit the bottom, but they should not be down there?
Well, you've highlighted one. Balance sheet strength and minimum level of debt are key. In an elevated interest environment, you don't want your cash flow being squeezed by huge financing costs. So we like looking at businesses that are nicely, stable, strong balance sheets, decent cash position, or good supportive cash flow. That's key as a sort of to underpin. Other than that, you need to look at growth. Are they still growing? How are they growing? Are they growing organically? That is absolutely key as well. So because you're buying to growth and to future returns, future cash flow. If companies are giving a dividend as well in the interim, you're being paid to wait. You know, if you're getting 4 or 5%, I mean, some companies, decent businesses, are yielding upwards of 6%. You're being paid a little bit to wait and it's affordable. Well, that's good as well. So it's growth, balance sheet strength, cash flow. I would urge everybody, and I would have urged companies, to forget chucking out this stupid EBITDA number. Yeah. We've had enough of it. The investment community. You said this before. Whoever invented EBITDA, I think it was an American, John Malone or something, invented the EBITDA phrase. It's not applicable for many of these smaller companies. So forget it. If you want to report something real, and it's not EBITDA is not a cash return. So, and investors should totally disregard it. They should be looking at the free cash flow returns of a business. How much cash, after all its investment needs, a business is generating. And that is absolutely essential. If the sooner companies start reporting that and put it front and center of their results, the better things will be. But let's get rid of this stupid EBITDA. It's just a waste of time.
Okay, well, let's move on to some of the companies. We've spoken about some of these before. I want to begin, first of all, with one that you've discussed with us, CVS Group. It's in the veterinary space, and we all know how much we love our animals. I can't go back to 2007 on this chart, but that gives you an idea as to where it's come from. We're currently at £14.67. I think I'd take that.
It's been a really great story, and I think it's a great example of what a little patience brings you, and the journey you should expect if you're in smaller quoted companies. Now, I know this is a long period, but quite frankly, even if you're in equities, you should be in it for the long term. This business floated at just over £2, and we actually came in. Some of our clients at IPO and some afterwards. The shares actually fell back to around about, I think, 80 odd p. So it took a bit of a whack to begin with at one point. So you've had two massive great drawdowns on this stock of more than 65%, I think. So between the starting point and where we are now, I think it delivered about 12 times money at one point. You've had quite a journey, and it's the sort of journey people should expect. At the moment, it's going through one of its weak periods again, because you've had a Competition and Markets Authority review of the veterinary services sector. The stock, when that was announced, I think the stock fell 30% on the day. I think this may result in some changes to the veterinary services sector. People complain that vets are overcharging, but I would counter that by saying, I had a dog sadly died a year or so ago, and you get pretty good service from your vets. You haven't got to wait for months like you do with a human healthcare.
CVS, is that a buy at these levels in your thought?
We're buyers. If history is any guide, it's been a very good guide for this stock. Any big sell-off, the business itself is still looking in pretty good shape. It's created a great buying opportunity. We think that's still the case with CVS. It looks in far better shape than it ever has.
I was interested to note that you've got a travel company on your wanted to talk, the list of stocks to watch. These have really come back amazingly since we've gone back into the air, in this case Jet2. What are your thoughts on this sector?
I think I don't generally like the airline or related sectors. However, Jet2 is a unique business on AIM. It's becoming a relatively unique business on the UK stock market. There aren't many, but and it does things very, very well. As you can see from the share price, it fell off a cliff over the height of the pandemic. Everybody was scared stiff. It then demonstrated a terrific response. It supported its customers very well. If you go onto the reviews, they're really, really excellent how it supported its customers, those that have paid for holidays. It's also got a fantastic balance sheet with loads of cash. It's got over £1 billion of its own cash. That is in addition to what it holds of customers' deposits. It's ordered a whole new fleet of aircraft. It's got, I think, it's ordered firm about 80 odd new Airbus, I think, and it's got some new, with a possibility to extend that. I think it demonstrates more than anything how to sweat its assets. It's always done that, I think. It's got a leisure travel group and an airline, and it offers this complete offering where it's controlling every aspect of your travel, which therefore helps your customer experience. So I think it's in great shape. You've seen this bounce post-COVID. Everybody would have seen their adverts. They're promoting like mad. Load factors are up. It looks in far better shape than, say, main market listed EasyJet in terms of the combined holiday offering. The founder's still got a huge stake in it.
Right.
I think it's an interesting, and the valuation, I mean, it's a 6 times forward multiple. Clearly, people don't believe those forecasts. They think that consumer pinch is going to impact their returns, but I think it offers for a reasonable price what people are after, and there's the potential to expand its offering. Well,
that's the thing, of course, is where we are at the moment at 10.71. Again, same questions I had for CVS. Is it a buy, or are you waiting for a better price to get in?
Valuation, I think it's a cracking buy. And even though if we're going to get there are some headwinds in the short term, I think this will be seen as a great time to buy into this company. In simple terms, applying some simple common sense, it does things really, really well. It does things better than rivals. That's proven. That's what its customers are saying in a big sector.
Let's move on. Take a look at the next one. RWS Holdings. We've spoken about this as well before. We've not interestingly spoken about it in the context of AI. We constantly refer to AI in pretty much every single sector. Yeah. This is an interesting stock in the face of what could be an AI headwind.
Yeah, I mean, this business, I think the market and investors are feared a little bit its vulnerability in the face of AI. At its heart, it's a patent translation business, and it's got a localization business and lots of other services around that. Clearly, they're worried about the impact of AI in that space. RWS has done its best over recent months to dispel that, highlighting its own AI potential, which it's been employing for some time. The shares have halved from the value is halved from its peak. And having always been viewed as sort of growth stock, and it is truly a world-class business, it's a very big player in its market globally. People are now viewing it as sort of a value play. I mean, it's offering now close to 6% dividend yield. It's in a net cash position. Cash flow is brilliant. It's been, as I say, investing a lot in its technology as well, which it's trying to highlight to the investor base how good it is. I mean, yes, there may be some hits in parts of, in the AI place, but for the type of work it does, it needs to be pretty precise. It's doing work for big pharma. You don't want to get things wrong. So I think there will always be a need for its services. And we would say now is a great opportunity to be buying this share. It's another one that's buying back its shares aggressively. Seeing a lot of share buyback. It's got a big committed share buyback. So that's clearly going to support the earnings.
But you're not on the whole in favour of share buybacks, are you?
No, I am for the right reasons.
Right, okay.
I'm not in favour if there aren't the right reasons. And I think if you look in the past, a lot of companies were financing their buybacks effectively through cheap debt. It was just a cheap cheating way of doing things. This business is supporting buybacks through internally generated cash flow, and it's still able to. And that cash is still able to support its growth and investment and acquisition should they arise. So I think this is a very good example. It's got a chairman that's been in there for a long time. Well, he stepped down now as chairman, but the main founder, shareholder, he's never sold a share in this business since it listed as a.
What are the chances of this standing alone in the future? Because we hear a lot about this sort of area where companies are owned for the likes of like Google or is the bigger players in the market. There are presumably in this area. What is it that RWS does which keeps it as a successful, albeit undervalued in your view?
It's very specialised, so it does very specialised work. It's not basic translation at all, and it's not the localisation bit is a bit more standardised, and there's probably more of a risk in that. But at its core, it does very specialised work for very high-end blue chip customers. And while AI may help that process, it won't offer, in my simplified opinion, an all-round sort of an overall solution. So there will always be a need for a sort of manual overlay of expertise for the time being. That may evolve, but AI is a help, but not a business sort of determinant or business prevention. And I think RWS still have a role there. It also, it's buying into other areas as well in the IP space. So yeah, look, it looks good value.
Let's move on to the last one, which is in the manufacturing sector, actually. So a company, again, we've spoken about before, AB Dynamics. This, you were saying this is in your notes, when you approached me with this, you were talking about this and its relationship with electric vehicles. We're talking a lot more about new technologies in motorised transport. This looks like it's in there?
It is. I mean, it also illustrates, once again, the journey that you should be expecting if you're in the smaller cap arena. Unfortunately, there are a few stories like this. But this business, it listed when it was market cap was about 14 million.
Yeah, that's right.
86p. Nobody was interested in it when it listed. It then sort of, you can see with the share price, well, even where we are now. But at one point, it was sort of giving you a 17 times, was now 17 times return. It was even better at one point, 20 odd times return. So great story, small company, needed the stock market for a reason, partial exit of founder, and then it started using the market to good effect, raising money to support acquisitions, and it's in the area of primarily in vehicle testing,
right,
and the simulation of that as well. So it creates sort of crash test dummies, suspension measurement systems, braking systems, robotic driving systems. It's also got into a retrofit self-driving area as well for the off-road vehicles and the construction vehicles area. That's a relatively new division. So it's at the heart of a really rapidly evolving sector, move to EVs, the new, more stringent safety requirements, the Euro NCAP as well. There are countless more safety requirements being imposed on automotive manufacturers, and this little business is a beneficiary of all that. The shares have previously been really highly rated, even more so than they are now, and they're still not cheap, but given that the market support, it could be a good time to get on board.
Yeah. One final question, going back to the big picture. How confident do you feel about the markets and where you are? You've spoken about a couple of companies you think there are buys, but in all honesty, we're not too sure about what's going to happen, where things are going to go. Interest rates still may go up again, according to most recent Fed statements as of the time of recording. How confident do you really deep down feel about where we are? Or do you think there might yet be better prices to get in at early next year?
There probably will be better prices, but who knows? I mean, I had a discussion with a client recently, why don't we go where the music's playing? Well, probably when you get to where the music's playing, it will have stopped, and where you were, the music will be playing back there again. You can't time a market. You're never going to get anything perfectly right. What you've got to look at, and I'm an equity investor, and I have to be a little bit optimistic. You've got to look at things the long term. It may not be the perfect buying opportunity, but look at your company, see what they're doing.
Get the fundamentals right.
Yeah, and have a look, have a guesstimate where it's going to be in a few years, roughly. You're never going to get it right. But if you really think little AB Dynamics might be somewhat more advanced in a few years, it's changing, it's got recurring revenue as well, it's got net cash, well, have a little bit, add to it. If it falls back a bit more, maybe add a bit more. If your prognosis remains the same, you've got to stick with it. You've got to be, unlike a lot of our larger institutional investors, you've got to be a little bit braver at the moment and patient. And I think the rewards will be there, but don't expect instant miracles. You're not going to. If you do, start worrying. If we suddenly see a 60% bounce, because that is exactly what can happen in small caps. The illiquidity can work the other way. Suddenly, everybody's rushing in, nobody's selling, and prices go whoop, like this.
Yeah. Okay, look, Chris, we'll leave it there. Thanks indeed for joining us. It's
okay,
a pleasure to catch up with you
you
again with some of the small caps and some of the talk in the markets. That's Chris Boxall from Fundamental Asset Management.